There's a common belief that a great investor is able to argue their investment theses and convince other people to believe what they believe. And that's actually not true. And if you do that, you are kind of falling into a trap, one that is not only going to drain you energetically, but also is probably going to eventually lead you to make poor decisions. And let me explain why that is and why a great investor is never one who just argues their investment. In fact, investing is very much about disagreement and accepting where we disagree. And so for an example, just think of Warren Buffett when he was very recently asked about what he thought about Paramount stock, which was one of his investments at the time. And instead of, arguing his case for it, saying, here's the valuation multiple, I think that the streaming services are going to consolidate and their content's going to be bid up, whatever, the thesis could have been at the time. Instead, he listed everything that was wrong with that investment thesis and then just moved on to the next question. In fact, he very commonly never actually defends any sort of investment thesis and is totally fine if you disagree with him. He actually welcomes it. That is because when you are really investing, and investing, what it really is it's the process of figuring out the probabilities of profit. And inherent in that idea of probability is that there's going to be probabilities of things not happening your way, of certain risk actually coming to form. And so a good investor is aware of these risks, but they don't argue why they don't think those risks are going to happen. They just accept them. Because the point is not that you can see the future and know what the future is. The point is that you are looking at this probability spectrum and you are comfort with the risk reward associated with that investment. And you believe over time, such investments are more likely to lead to better results than worse results. And so that's why Warren Buffett is not there arguing about why he is correct. Instead, he's kind of just saying, let my record speak for itself. And so that's one reason why great investors don't get stuck in these sort of arguments. And I'll tell you, I'm very good at arguing, and I could argue something that is probably a really bad investment and convince you to do it. I just know, generally speaking, I can sound smart enough that can confuse enough people that could get them to do that. And I don't want to do that, but I know if the game was who can win a debate, I would be pretty well versed for that. Except sounding smart is very different than being correct. And in fact, there's a lot of people that just aren't that great at defending their investment thesis or not that articulate, because it's a very different skill than being right on an investor. There's all sorts of investors that have made great bets over time, but have just never been really great at arguing them. And conversely, there's some investors that are really good at defending what they do and explaining what they do, and they're pretty mediocre investors, but it serves as good marketing. And to give you an example, and this is an example that I'm not proud of, but it's true, although I don't exactly know that was the wrong decision at the time. And it was that when I was in college about a decade ago, I was a part of this student investment fund, and one of the stocks in the investment fund was NVIDIA. And I was arguing why we should not own NVIDIA. And my argument went something along the lines of touching on valuation, touching on the fact that R&D as a percent of sales has been increasing and yet growth has not been accelerating, suggesting that there's more sort of investment going into the business just to support existing sales. There's also sort of competition factors that were listed. And the biggest thing and the biggest reason why was that no one in the investment group actually understood what they did. And so I was able to argue that our lack of knowledge and understanding of this business meant that we should not own it, which is honestly fair enough. But I never did try to actually understand it at the time, which of course you could say was my mistake later on. My point being though that I was good at arguing and I was able to get that stock out of the portfolio, even though we could say now in retrospect that doesn't seem like that was the right decision. I'm giving myself a little bit of a pass though, because no one knew what the business did at the time when I was arguing that. But the point being that a good argument is very different than being correct. And so when you do have an investment thesis and you see these risks kind of populating in your investment thesis, maybe right now another example is Constellation Software. They acquire and own a lot of these small vertical market software businesses. Now, these are businesses where the entire TAM is maybe $5 million because it's a super niche software application, like selling software to chicken coop owners or selling software to the Ontario municipality for their bus scheduling. That is the entire use of that one piece of software. And so they're very niche. There's actually, though, a lot of these sort of niche software applications out there. and been acquiring them since the early 90s. This is Mark Leonard, who was the founder of this company. He's kind of actually known a little bit like a Canadian Warren Buffett because of the way he thinks about capital allocation and the fact that he did find this opportunity, 30 years ago to invest in these companies that are not growing, but he'd buy them at very, very cheap multiples, sometimes, 1 to 2 times revenue multiples for, a software company that is very great. And then once they'd own it, they were able to expand margins a little bit and basically just take the cash and redeploy it elsewhere. And so that is kind of why it's known a little bit like a Canadian Berkshire Hathaway, but that is not the point. The point here is right now, there's a lot of fear that AI is going to displace them because AI now makes it much easier to write software. And so these small markets that they own software in, now more people are going to be able to attack them because the barriers to entry are lowering and it's even easier than ever to make software before. And maybe the businesses themselves are going to code the software and just replace them entirely. And my personal take is that is a misunderstanding of the competitive moats that Constellation has because it never was the barriers to entry that were the issue. A lot of this software was originally built by, a 1-person or 2-person team. It was never a big team that was necessary to build this software. It's not particularly complex. It's just not profitable for other people to make it. And so does the fact that AI can now code a software really cheaply all of a sudden mean more competition exists? Yes. But the reason why these are good businesses is because of how sticky the customer base is. The fact that a business owner who's running, some dentist software from 20 years ago doesn't want to go and retrain his staff and pull out his existing software that's been working perfectly fine for another software thing that maybe is a little cheaper, but potentially doesn't work, potentially doesn't integrate, requires them retraining everyone. And by the way, they just don't want the headache of dealing with that. It's just not a big cost to their business that they care to. And so that's why the software tends to be very, very sticky. And a lot of times too, a lot of the software is customized by the customer themselves for a very specific thing they want, and Constellation software works with them to customize it to their needs. And so does AI mean more competition exist? Yes. Does that change the fact that customers do not want to rip out a service that is already working fine for them? Yes. Do people disagree with me on that? Yes. And that's totally fine. That is exactly what makes a market is disagreement. We would never be trading stocks if some person didn't think the stock that you were buying was going to go down. He sold it to you thinking that you were wrong and you bought it because you thought he was wrong, putting out some of the other factors why you sell a stock. And so that is why a disagreement is inherent. But arguing in this idea that you need to prove someone is correct or wrong is kind of means that you're on the wrong track because, to be honest, yes, that risk still exists in this investment. Now, I have my own opinion on what I think will happen, but I don't know the future. And I am just doing my best to make my own judgment on what I think the probabilities of profit or loss are going to be. And that is what makes investing. And so when you are stuck in this position of arguing, it kind of also means that you don't really believe what you're saying that much, and you feel like you need the validation of another person to say you are correct. And if that is the case too, you're kind of outsourcing your judgment to someone else. And people do this all the time. They feel good when a sell-side analyst has the same rating as their stock, or an investor owns their stock that they own. And sometimes people just copy other investors too because they want to outsource that judgment completely to someone else. And I'm telling you, that's not investing. Because when you are investing, disagreement must exist. And so otherwise that opportunity is just not going to be there. And so I want you to understand that investing is accepting risk. It's not arguing that it won't happen. It's accepting that it could happen and being okay with the investment anyway. And so if you think about all these people that have investments in China, there is very much a risk that they continue to socialize some of the profits. They did that directly with something like the Common Prosperity Initiative in China, where at the time they had all these tech companies made these very big donations to a Common Prosperity Fund that was somewhere around 10 billion yuan off the top of my head. And so not nothing. And then on top of that, they took 1% stake in all of these different companies and took board seats as well. And they took a 1% stake. Could it theoretically be more? Yes. Do they want to do that? I don't know. That is though, this conversation you're having when you are investing in a country like China. And some people are comfortable with those conversations and they have opinions about what they think is going to happen. And other people just don't want to accept that risk. And that is totally fine. That is what investing is finding the risk you're willing to accept. It's not saying that risk doesn't exist. It's saying that I just either don't think that risk is as big as other people think it is, and so the probability is lower, or I just think that the profits of upside are just so high that I'm okay accepting that risk. And that's a little bit more VC investing. A VC investor never is saying that, oh, I don't think this startup is ever going to go bankrupt. They're saying, I think it's going to be 100x if it works. And they're not really worried about that downside risk because they have all these different bets and they just need one to hit. And that is also why the way that you invest and the positions you take need to be tied into how you're actually diversifying and your overall portfolio allocation. And portfolio allocation is so critical to risk management, but people mess that up all the time. And so watch this video here if you want to see a new way on how to think about portfolio sizing, because again, this is just something that investors never properly think about until it is too late. And if you want to continue to learn more about business and investing, go ahead and hit like and subscribe and drop any questions you have or things that you want to see us talk about in the future in the comments below. Thank you for listening.